Investors' interest in cryptocurrencies is skyrocketing, and that also introduced a problem to the crypto market that earlier plagued the stock market. We are talking about front-running that cost unsuspecting traders $280 million every month worldwide. So how exactly can you avoid front-running? Well, that's exactly what we discuss in this video. So why not stick around till the end to know how you can avoid front-running in crypto? Before we begin, make sure you check out the description below for some of our recommended crypto websites and wallets. The decentralized cryptocurrency market has opened new doors for traders, and even the stock market purists are now migrating to cryptocurrencies to make a profit. This makes sense because cryptocurrencies are a one-of-a-kind asset with high risk and high return nature. But what plagued the stock market is now here with us in the crypto market, and investors are not so happy about it. If you're new to investing, front-running might be a very new term for you. So what exactly is front-running? Well, front-running is an illegal practice of using insider information to make purchases, knowing that the other party is also going to buy the same asset and then sell it at a higher price. Simply put, front-running is a practice of trading cryptocurrencies based on publicly unavailable information about a future transaction. It might be an illegal practice with the stock trading, but that is not the case with crypto transactions. Front-running on decentralized finance is becoming a much more complex and depressing issue, at least according to Douglas Horne, who happens to be Telos' chief architect and white paper author. He said, "It started with individuals using bots to offer high gas fees to jump the line in front of high-value transactions. Today, front-running has evolved into a multi-billion-dollar ethical malpractice. Front-running happens when miners are able to access information about some pending transactions to take advantage of trades by buying or selling before the original owners. The Ethereum blockchain is right now plagued with front-running where bots are able to quote a higher gas price, and the miners will favor these bots instead of actual investors. The other parties who are capable of front-running would be full node operators. These are the people that are tasked with observing the network activities to ensure that there are no irregularities. Fun fact, even cryptocurrency exchanges can execute front-running, but they don't want to cheat their own customers because if they do that, their reputation will be at stake. Apart from all the obvious monetary loss, front-running can also break the trust of many existing and potential investors, making front-running a very serious problem that crypto platforms must address. So how can you prevent front-running in crypto? Well, that is exactly the reason why you're watching this video, right? Number 1. Keeping maximum slippage low. If you don't understand what slippage means, well, slippage is the difference between the expected price of an order and the price when the order actually gets executed. A slippage percentage shows you how much the price for a specific asset has moved because you know that cryptocurrencies are extremely volatile, and the price of the assets can fluctuate depending upon trade, volume, and activity. One good way to deal with front-running would be if you set up maximum slippage tolerance, which is possible in most decentralized exchanges. To make things simpler, you can fix the maximum deviation from the expected return. Let's say if you placed an order in a decentralized exchange and you expect a return of 500 Ether. If you set the slippage to 1% of your order, you wouldn't be receiving anything less than 495 Ether. However, if higher slippage tolerance is greater, then there will be more deviation. So things are really simple. All you need to do is keep your maximum slippage low, about 0.5 to 2% to discourage front-runners. Now, if you want to place a large order, then you need to keep your slippage at the lower value, because front-runners often want you to keep your slippage high, so you need to outdo them by doing something they won't even expect you to do. Number 2. Placing a low-value order. It's not easy for a front-runner to make a lot of profits without meeting minimum thresholds. They have to pay gas fees twice on entering and exiting the market, and they also have to recover the amount paid as trading fees. Their profits only begin after they get back their investments. The Ethereum-based automated market makers such as Uniswap, SushiSwap, and Balancer pay gas fees of about $25 per transaction. They need only 2 transactions to execute front-running, which means they are likely to spend $50 to complete the trade. It also means if your trade is earning less than $50 profit, you are less likely to become the target of front-runners. So this way, when you enter a low-value trade, you're practically making it unprofitable for front-runners. Most of the time, trading with any amount under $1,000 is safe. Number 3. Paying extra gas fees. Well, this might not be a popular opinion among investors, but hear us out. Front-runners are happy to see slow transactions because it gives them more time to plan an order for your trade and make profits. If you are looking to underpay gas fees, then miners will choose the transaction with higher gas fees, which means you will have to wait a lot longer for validating your transaction. This will provide front-runners more time to formulate their strategy. But it's not all bad news, because you will be able to turn the tables if you are willing to overpay gas fees, and this will motivate miners to validate your transaction faster and minimize your odds of becoming the target of a front-runner. When you are overpaying gas fees, you're doing exactly what a frontrunner does, but better. All you need to do is set your gas price to a higher than average value, and you are good to go. Number 4. Using large liquidity pools. A small liquidity pool might be the favorite of frontrunners because there is less chance of competition as well as disruption of transaction by a large order that unexpectedly changed the pool weighting. So if you want to solve the front-running issue, executing your trades in a large liquidity pool will make you less susceptible to front-running. Number 5. Finding a taker. Taker might be a new term for you, especially if you are new to crypto. So if that is the case, then a taker is a trader who takes liquidity out from the order book. A publicly hosted order book is the very first thing that draws the attention of frontrunners. If you manage to find a taker, you'll be able to fill a given order, and you will also be able to keep away from public markets and frontrunners. If you find a taker and negotiate a price successfully, a trustless on-chain exchange gets executed, and you successfully got rid of frontrunners. But these are the preventive measures that should be taken by traders like you. What about decentralized exchanges? Well, decentralized exchanges need to be designed in such a way that they discourage frontrunners. It all starts with, number 1, decentralized match engine. When you look at a centralized match engine, it's extremely difficult to establish that the exchange itself is not involved in front-running. But with decentralized matching engines, things get a lot easier, because these matching engines will allow anyone running a full node to view the matching in real time. This way, they can match the transaction in the latest block manually with the current order book. Number 2, quick matching. Frontrunners look for slow matching speeds to place their orders before execution, which means that a decentralized exchange can ensure fast matching to leave little to no room for frontrunners to put their tactics into practice. Extremely fast block times will effectively make frontrunners unable to react, and this could discourage most frontrunners, at least the ones who are not so technically inclined. Number 3, periodic auction matching. Periodic auction matching adds that extra layer of security from frontrunners. This is done by adding a non-deterministic layer, making it impossible for anyone to know the next execution price unless they are aware of the matching logic, the incoming orders for the next block, and the trade price in the current order book from the last match. We don't know whether front-running will be an issue with the Ethereum 2.0 once it's fully launched in 2023. Ethereum 2.0 will be introducing staking and validate transitions using a proof-of-stake consensus mechanism. The validators are given their positions ahead of time to process transactions in an epoch. Front-runners may also have a longer time finding profitable trades in a crowded space, but the possibilities of a front run is still there, especially for those people who are more technically inclined. For those of you who don't know, an epoch is a definite span of time in a blockchain network, and this time frame is used to describe when certain events in a blockchain network will take place. And a final note, this video is meant to be infotainment content and should only be viewed as such. Any investments that you make in a cryptocurrency market must be made at your own risk, considering the volatility and uncertainty of these assets. There are several members of the crypto community that have varying opinions about the ethics of front-running as a legitimate trading strategy. Some think of front-running as a very fair game with publicly traded information, but most crypto enthusiasts are completely against the practice because this just manipulates the prices of the assets.